Good day everyone. I am Nisi Santisas with my group Savannah Santoya. We'll discuss Chapter 13, Basic of Commercial Banking. So, commercial banking is a type of banking that provides services for businesses, government agencies, and institutions like colleges and universities to help them grow and profit. So, kining commercial bank mo help sa job to make money, mainly by loaning money to the business and earning back interest and fees from these loans. So, kining a bank or banks loan money to businesses to cover supplies, real estate, hiring, or any other costs the business might incur. Yet, there's much more to this field than lending. They perform various services to help funds businesses and provide financial support. So the main purpose of commercial bank is to provide services to the general public and also provide loan facilities to the business, which helps in ensuring economic stability and growth of economy. The bank balance sheet summarizes banks, sources, and use of fund is a statement and lists and individuals or firm asset and liabilities to indicate the individuals or firms financial positions on a particular day. So it provides information on a company's resources, which is ang assets, and its sources of capital, which is ang equity and liability or debt or utang. So kining asset is something of value that individuals or firms own. Asset is a resource of value that can be converted into cash, while ang liabilities is something that an individual or firm owes. Equity is a difference between the value of the bank's assets and the value of its liability. While ang bank assets consist mainly of various kinds of loans and marketable securities and of reserves of base money, which may be held either as actual central bank notes and coins or in a form of a credit or deposit balance at a central bank. Next, securities is a marketable securities are liquid assets that banks trade in financial markets. While ang bank holding government treasury gani ang maghawid ana, so matawag na to na siya og secondary reserve. It is a fungible and tradable financial instrument used to magamit nato siya para ma-raise ang capital sa public or private markets. Loans receivable is the largest category of bank asset is loans. So ang loans are illiquid, greater default risk, and higher information cost. Banks receive higher interest rate loans to business, consumers loans, real estate loans, while ang other assets is banks physically asset, computer equipments, buildings, or collateral received. Bank liabilities is the most important bank are the funds can give banks will funds acquired from savers. There are types of deposit accounts. First is demand or current account deposit account against which depositors can write check. Ang kining demand deposit are current accounts deposit on which banks do not pay interest. While ang now accounts mo check na si job accounts nga mo bayad og interest. While kining non-demand deposit, savers use only some of their deposit for day-to-day transactions. If ang savers who are willing to sacrifice immediate access to their funds in exchange for higher interest payments. Savings accounts, money market deposit accounts, time deposit is a certificate of deposit. And lastly is the borrowings.
Borrowings. So the borrowings obtain funds including short-term loans in the BSP, loans from foreign branches, repurchase agreements, and discount loans. So the federal markets allows to lend reserve to each other overnight. So for example, borrowing at 2% and lending at 5% yields a profit margin of 3%. So the banks must manage credit risk and navigate interest fluctuation to maintain profitability. Bank capital. So the bank capital is the difference between a bank's asset and liabilities, and it represents the net worth of the bank or its equity value to investors. Basic operations of a commercial bank. So commercial banks aims to find the optimal mix of assets and liabilities to succeed in dynamic financial landscape. Management of bank assets. So, bank asset management is also about striking a delicate balance. Banks want to maximize profits by earning the highest possible returns on their assets, but they also need to manage risk and revenue. They have enough liquid assets to meet depositors' demand. Management of bank capital. So the banks manage their capital to prevent failures and meet regulatory requirements while balancing the need for safety against the desire for higher returns to equity holders. And it manage often prefer to hold less than capital than required due to the costs associated with maintaining high capital levels. Bank capital and profit. So, bank capital represents net worth, while profit measurements of profit before tax divided by total assets in bank. Managing bank risk. So, there are three types, which are the managing liquidity risk, credit risk, and the last, the entry risk. So, the liquidity risk, maintaining a portfolio of high quality liquid assets that ensuring that cash needs are continuously met. The credit risk, the probability of a financial loss resulting from a borrower's failure to repay a loan. So there are six methods can use to manage credit risk. One, the diversification. It spread loans across the borrowers and industries. The credit analysis that evaluate the creditworthiness. Collateral, requiring assets. Credit rationing, limiting credit. Monitoring and restricted covenants, imposing restrictions. And the last, the long-term relationships. Managing interest risk. It can be managed through the mix of loans and deposits, although this can result in either too much risk on the balance sheet. That's all. Thank you.